Welcome to MultiPrime Briefings. I'm Matthew, and joining me as always is Ruth. This week we've got a genuinely packed agenda. Thailand's making the biggest economic policy bet it has in years. The Fed is showing cracks in its hold posture. PwC managed to publish an academic study that doesn't exist, and Southeast Asian private equity basically went on holiday. Ruth, where do you want to start?
Thailand, obviously.
Obviously. So here's the thesis. Bangkok announced a 5-pillar economic restructuring plan this week. 30% of GDP in total investment, 100 billion baht specifically into AI and semiconductor infrastructure by 2027. And it landed the same week as two major infrastructure moves. True Internet Data Center seeking a $2 billion syndicated loan for a Bangkok area facility, and Gulf Edge, that's the digital arm of Thai energy giant Gulf Development, forming a JV with Cognizant to deploy sovereign AI platforms across banking, energy, manufacturing, telecoms. On paper, this is a coherent, funded, multi-actor push toward making Thailand the regional AI hub.
On paper, right. And that's doing a lot of work in that sentence.
It is. But I want to defend the ambition for a moment before we tear it apart, because I think there's a reflex in this region to be cynical about Thai government economic plans, and sometimes that cynicism is lazy. This is actually specific. It names sectors, semiconductors, green energy, financial services. It names a capital target. It's not a vision statement. It's a program.
It's a program with a 2027 deadline.
Fair.
Which is 18 months away.
Right, and that's where the execution gap opens up. The same week all of this was announced, a survey covering 6 ASEAN markets, including Thailand and Malaysia, dropped a number that I think is the most important data point in the whole digest. Only 13% of organizations in ASEAN consider themselves digitally mature. 13%.
13. Out of 100.
Out of 100. And what the survey is actually measuring isn't whether you've bought software. It's whether the technology you've deployed is being used effectively, whether employees trust it, whether leadership and the front line are aligned on what the tools are for. The finding is that fragmented, poorly implemented AI tools are creating workforce fatigue. People are being asked to use more systems, with less coherent training, and the result is a trust gap between what the C-suite thinks is happening and what actually is.
Which is the mechanism by which ambitious programs quietly die. Not with a bang. With 1,000 ignored notifications and a Teams channel no one checks.
Exactly. And this is why the Thailand story is interesting as a case study rather than just a policy announcement. You can build a data center. True Internet raising $2 billion. That's real. That's financeable. The market is there. You can ink a JV like Gulf Edge and Cognizant and get a press release out. The physical infrastructure is actually the easy part now, because capital follows signal and the signal from Bangkok is clear. The hard part is the layer above the concrete. The talent pipeline, the governance frameworks for sovereign AI, the regulatory clarity that tells a foreign hyperscaler whether their data residency obligations are compatible with the Thai investment framework.
And there's a specific compliance wrinkle this week that cuts right across that foreign investment story. Thailand also tightened its nominee shareholder rules. New financial verification requirements for companies where foreigners hold signing authority or have invested. Targeted enforcement in high-risk provinces.
Right, and I want to be clear about what that means strategically. On one hand, it's legitimate rule of law enforcement. Nominee structures are genuinely a circumvention mechanism. On the other hand, the timing creates a signal versus noise problem for inbound investors. You're trying to attract $100 billion in AI investment while simultaneously signaling that the Ministry of Commerce is running document verification sweeps on foreign-linked entities. Those two messages need to be very carefully managed.
The risk is that the enforcement sweep catches some legitimate JV or restructured holding company in the crossfire, and suddenly that becomes the headline foreign investors see instead of the 5-pillar plan.
Precisely. Watch for any high-profile enforcement action in the next quarter. That's the canary. If the first case is genuinely egregious nominee abuse, fine, that actually builds credibility. If it's a multinational with a mildly unconventional structure, you've got a problem.
Okay. So what's the net verdict on Thailand's AI ambition?
My position, the infrastructure layer, data centers, JVs, capital, will get built, probably on schedule or close. The productivity layer, where this actually shows up in GDP, is 3 to 5 years behind where the plan implies. The companies that win are the ones building that capability bridge right now. The integrators, the training providers, the local AI platforms that can run on sovereign infrastructure. The ones that lose are the organizations that wait for the infrastructure to arrive and assume the productivity gains follow automatically. They won't.
That's a reasonable place to land. Let's move to macro, because there's a lot happening in the central bank world this week, and some of it is genuinely consequential for this audience.
So the Fed held rates at 3.50 to 3.75%, fifth consecutive meeting with no change. That in itself is not news. What is news is that 3 members dissented and called for a hike. 3 dissenters on the hawkish side is not a small thing.
3 dissenters is a lot.
It's the Fed telling you, in the most official language it has, that the next move is more likely up than down. The driver is energy price-driven inflation with a geopolitical tail, which is not something rate hikes fix efficiently, but the Fed is running out of other tools. For Thai CFOs with USD-denominated debt, this is the scenario you were hoping wouldn't materialize. If rates go to 4%, the baht dynamics and the refinancing math both get ugly.
And the Bosch situation is interesting because it's moving in parallel. They held at 1%, but the hawkish signal plus the US-backed yen intervention, that's a coordinated communication. The message is, carry trades funded by cheap yen are a risk you should be pricing out of your portfolio.
The US backing the yen intervention is the detail I keep coming back to. That's not a routine intervention. That's a bilateral agreement with geopolitical subtext. It says the US has an interest in yen stability, which is probably connected to the broader picture of Japanese defense spending and security commitments. When currency policy and security policy are this entangled, the yen is not going to be allowed to weaken past a certain threshold, which is good for regional FX stability, but it does close off a funding arbitrage that some ASEAN corporates have been quietly using.
Meanwhile, the ECB hiked 25 basis points. So you have the Fed holding with hawkish bias, the BOJ holding with hawkish bias, and the ECB actively tightening. Every major central bank is leaning the same direction. That's not a mixed signal environment. That's a directional signal.
Right. And the McKinsey Global Economics Intelligence Summary flags exactly this. Geopolitical uncertainty is keeping energy prices volatile, which is keeping inflation sticky, which is keeping central banks in tightening mode longer than their own models predicted. The scenario where rates come down meaningfully before end of 2027 is getting thinner every week.
Okay, industries. Let's do the PE story because that number deserves airtime.
58% drop in Southeast Asian PE deal volume in Q2 2026. That is a dramatic number. A Parthenon put it out and I'll give them credit. They didn't bury the lead. Deal volume collapsed, but exit values hit a 4-year high at $4.2 billion.
So sponsors are selling everything they can, buying nothing.
Which is a very specific posture. It tells you 3 things. 1. Sponsors think current valuations are at or near peak for the assets they're holding, so get out now. 2. They're not finding new assets at prices that make sense given their cost of capital, because remember, their own fund financing has gotten more expensive as rates have risen. 3. LP pressure for distributions is real. 4-year high in exit values means someone demanded that cash come back.
Which means for management teams running businesses that might have been PE targets, or hoping for PE investment to fund expansion, that window is basically shut for the next few quarters.
Until the macro picture clears. Which loops back to the Fed dissenter story. If rates go up again, that window doesn't reopen in 2026, probably mid-2027 at earliest. Strategic acquirers and trade buyers have an opportunity here that they don't always have. PE is not competing for assets right now.
Okay, that's actually a useful insight for this audience. If you've been in a competitive process against PE for an acquisition target, the dynamic has flipped.
Completely flipped. On to ASEAN EVs. Malaysia's Federation Presidency pushing for regulatory harmonization. The headline is good. The substance is familiar.
How many times have we heard ASEAN harmonization?
At least once per Malaysian presidency, I feel like. Look, the strategic logic is unimpeachable. If ASEAN can standardize EV charging standards, homologation requirements, and battery supply chain certification across 10 markets, it becomes a much more attractive destination for advanced manufacturing investment than if each country is its own regulatory island. China's BYD and the major Korean players are watching this closely.
But ASEAN harmonization historically moves at the speed of its most resistant member.
Exactly. And in EVs, you've got a wide divergence of interests. Thailand wants to protect its IC auto sector transition. Indonesia wants to leverage its nickel. Malaysia wants to be the assembly hub. Those interests don't harmonize neatly. What to watch? Whether the output of this process is a binding technical standard with an enforcement mechanism, or a declaration of intent and a working group. If it's the former, this is genuinely significant. If it's the latter, we'll be having this conversation again in 2028.
All right, Capability Corner. This is a meaty week. AI fatigue, the nominee compliance story we already touched, and PwC.
Let's do PwC first because it's both important and, I'll admit, kinda darkly funny.
Oh, I have thoughts.
PwC published thought leadership reports in the Middle East, on AI and on electric vehicles, that contained fabricated citations, not just slightly wrong citations, fabricated, non-existent web pages, and an entirely invented academic study on air quality. Someone at PwC used an AI tool to write or research content. That tool hallucinated, and whatever review process exists did not catch it before the report went out with the PwC logo on it.
An invented academic study. That's not a typo in a footnote. That is the core finding in a section of a published report.
Right, and here's why this matters beyond the obvious embarrassment. PwC is one of the firms most actively selling AI transformation advisory. They are telling clients, here is how to govern your AI. Here are the quality controls you need. Here is how to prevent exactly this kind of error from undermining your operations. And simultaneously, their own content production pipeline failed a basic hallucination check. The governance gap is not hypothetical. It's happening at the highest credentialed organizations in the market.
Which should terrify every management team that's been letting AI-generated content flow into client-facing materials without a proper review gate.
The lesson is not don't use AI for content. The lesson is, the review gate is not optional, and it cannot be another AI doing the checking. You need a human who can actually verify a citation exists by trying to find it. That is a 10-minute task. The failure here is process design, not technology.
Now, the AI fatigue research is interesting because it's the flip side of the same coin. PwC's failure is about AI being used wrong at the production end. The ASEAN fatigue research is about AI being deployed wrong at the consumption end.
Yes, 13% digitally mature. And the mechanism the research identifies is fragmentation. Organizations are deploying many different AI tools, often without clear use case design, without training, without any governance structure for what the tool is for. Employees are being asked to adopt new systems at a pace that exceeds their capacity to integrate them. The result is fatigue, distrust, and ultimately non-use, which is the worst outcome, because you've paid for the tool and gotten none of the productivity benefit.
And 87% of organizations are apparently in this bucket.
Which is a sobering number when you set it next to the Thailand 5-pillar plan's assumption that AI infrastructure investment translates into productivity. It doesn't automatically. The 87% are the evidence.
What's the fix?
Fewer tools, better designed. Centralize the AI governance so there's a coherent architecture rather than 100-point solutions each with their own login. Invest in change management at the same budget level as the technology itself, which almost no organization does. And measure adoption and trust, not just deployment. Those are different metrics. A tool that is technically deployed but has a 12% active user rate has not been adopted.
Sounds like something an advisor would say.
Ha! Guilty. Let's do the firms.
McKinsey had a busy week.
They did. 3 pieces worth discussing. First, the Brynjolfsson interview on whether AI productivity is at a turning point. Brynjolfsson's J-curve framing is genuinely the most useful mental model for where we are in AI's economic impact. The idea that productivity gains require complementary investment in restructuring work processes, and that curve dips before it rises. We're in the dip. The interview is honest about that.
My pushback. McKinsey uses this framing in a way that implicitly lets organizations off the hook. We're in the J-curve trough, so the gains are coming, just be patient. But the length of the trough is not uniform. Organizations that have already built data infrastructure, data culture, and clean process architecture are going to exit the trough years before organizations that are still running on fragmented legacy systems. The J-curve is real, but it's not the same J-curve for everyone.
That's a fair critique. The piece doesn't disaggregate by organizational starting point, and that's where the practical guidance lives. If you're a Thai bank that has been investing in data governance for 3 years, your J-curve looks different from a mid-size manufacturer who just bought a ChatGPT enterprise license last month.
Different curves, different timelines.
Second piece, McKinsey's Japan Reinvention Report argues that bold corporate dynamism can reset Japan's growth trajectory. I think this report is analytically honest. It's not pretending Japan's structural problems are small, but it underspecifies the mechanism. The report is essentially, if Japan does these things, growth will follow. What it doesn't grapple with is why Japan hasn't done these things for 30 years, which is a political economy question, not a strategy question. Shareholder activism and governance reform are moving, yes, but the speed of change in Japanese corporate culture is not going to be accelerated by a McKinsey report. however well written.
To be fair, that's true of most McKinsey reports about national economies.
Yes. The third piece is the most interesting and I think underrated, McKinsey's analysis of whether the AI data center power build in the U.S. risks overbuilding. Their conclusion is no, even if compute demand comes in 20 or 30% below current projections, the power infrastructure won't become stranded. The reasoning is that grid modernization and industrial electrification will absorb capacity even if AI-specific demand disappoints.
Which is relevant for Thailand because the True Internet $2 billion raise is essentially a bet on that same thesis, that the infrastructure won't be stranded. The question for ASEAN is whether the grid modernization and industrial demand absorption story holds in emerging market infrastructure contexts, where grid reliability and industrial electrification are at very different starting points.
That's exactly right, and I'd push back on applying the McKinsey U.S. thesis directly to Southeast Asia without adjustment. The U.S. assumption is that the grid is reliable enough and the industrial base large enough that even if AI demand misses, there's an absorption market. Thailand's grid is improving, but it's not the U.S. grid, and the industrial base, outside of EV-adjacent manufacturing, isn't deep enough yet to absorb a large stranded data center capacity. So the risk of overbuilding in ASEAN is materially higher than in the U.S., and that's a risk any lender to the True Internet deal should be modeling explicitly.
Okay, let's close. What are the 3 things you're actually watching this week?
1. Whether the Fed dissenter count goes to 4. The moment you have a majority of dissenters on the hawkish side, a hike becomes the base case, not the tail risk, and every capital plan in this region needs to be stress-tested for that scenario. 2. The first binding output, or lack thereof, from the ASEAN EV harmonization push under Malaysia. One concrete technical standard would be more meaningful than the announcement itself. 3. Whether Thailand's nominee shareholder enforcement produces a high-profile case in the next 90 days, and whether that case is clearly egregious or ambiguous. The ambiguous case is the dangerous one for inbound investment sentiment.
My one ad. Watch PwC's response to the hallucination story. If they treat it as a Middle East regional incident and move on, that tells you something about how seriously the major advisory firms are managing their AI content governance. If they announce a firm-wide review of AI-assisted publications, that's actually good news. It raises the floor for the whole industry.
The thread connecting all of it this week, and I'll say this as plainly as I can, is the gap between ambition and execution. Thailand has the most coherent economic plan in years and a real infrastructure pipeline. 87% of ASEAN organizations can't make their existing AI tools work. The Fed is holding because it wants to believe inflation will behave and 3 members have stopped believing. McKinsey tells Japan it can have dynamism. Japan's political economy has heard that before. Ambition is cheap. Execution is the constraint. That's this week.
Well said. Thanks for listening to MultiPrime Briefings. We'll be back next week. Until then, build accordingly.